And we are officially kicking off our final installation of our Angel Investing Miniseries. Today's session, which we're calling Your Portfolio and After the Check, is really to kind of bring it home. We talked about, foundational concepts. We spoke about some kind of introductory things and real world examples of what we see when we're investing, what we're, thinking about. And what should you think about and how do you get more strategic with allocations and what happens after you write the check? That's what we're going to be talking about today. As always, we want to make sure these are informational. So don't feel like you need to sit on a question. You can drop it in the chat. You can come off mute or come on video, however you'd like to participate. Um, don't ever be embarrassed or think that your question is silly. If you want it to be confidential, you of course are welcome to send it and say, I prefer anonymously, or send it through Rachel, who's one of our team members on the call. But we really encourage, again, that participation. And if you have questions, we want to slow down. So let's jump into it. We have a lot that we're going to cover today. And y'all probably already know my background, so I'm not going to spend any time on this slide. But I just want to quickly, acknowledge that this isn't something that I learned because I read about it. This was from doing it, right? And so the investment, concepts and, the decisions we at She's Independent are actually allocating. It's not just education, even though we love the education piece. We love the how do we get folks that maybe are new to this or want to step into it or feel more confident or, skill built. We want to do all that, but deal making is at the core of, how we operate. So think of these educational, workshops and what we do as just kind of assisting in or being something that if you're not ready to write the checks yet, or if you want to get more confident, hopefully this is helpful. But we're always open to feedback, of course, and your participation. So what are we going to cover? Allocating and a nod to mindset, right? What do those checks look like, and what might you want them to look like? Talk a little bit about money, of course, and then portfolio thoughts, risk, expectations, right? How long are these, investments going to be invested? Um, what can happen, right? M&A, maybe it goes to zero, right? There's all these things. And then we're going to provide, various examples that say, all right, just to be transparent, if there are costs and if there is what's called dilution, which we'll get into that, what does that look like on a return basis if that happens? So again, what to expect. And when you're thinking about allocating, there's so many things to think about. Outlining just some of that, here. I think one of the first things people are thinking about is like, okay, what kind of check am I going to write? What size check? And we would suggest or nudge you to not just say, oh, what's the lowest check I can write? Not that we're trying to get you to, maximize the check you're writing with us, but we want you to think strategically for your portfolio and for how you step into money and money flows. We'll talk about that. We're going to talk about, again, your portfolio. So you don't want to think about writing one check or two checks. Why? We'll talk about that. And then again, kind of what are the taxes? What's going to happen? What is my accountant going to get? What am I going to get? And then, again, kind of that reminder of whether it's goal setting or coming up with, how you want to grow as an investor. So to expand a bit more on check sizing, love that She's Independent pen right there, right? The back of the envelope that people talk about when they talk about Angel is risky. We are not shying away from that. And we never want to sell you on, oh my gosh, we're making great investments, they're all going to pay off. Like that doesn't work. Sure, we're making solid investments and looking at risk and, diligence, but there's always risk. So when you think about Angel, which is a private, meaning illiquid, you can't just get out of this stuff. You're probably tied up for years. We'll talk about that. The back of the envelope that a lot of people, basically come to in terms of asset allocation is 10% or a certain percentage of your net worth. And why do I say 10% or X? It goes without saying, but if you have a ton of money, right, then having reserves may look different than if you have just the $1 million threshold that makes you an accredited investor. What do I mean by that? If I have $1 million, then maybe the 10% is a good threshold. If I have $10 million, maybe I want to put in 20%, right? Like you can determine what you want that to look like. But again, we're just sharing with you the way the industry and a lot of folks, talk about this. Um, if you're thinking about check sizing, you can reverse engineer, check size and say, okay, maybe I have $2 million and maybe I want to put 10% or another percentage. Great. So if I want to do 10% of 2 million, 200,000. And if I want to write 20 checks, that's 10,000 each. And so you can think about this not as okay, I have never done this before and I'm scared. Like if you're investing alongside, others, if you really like a deal, step into, what feels good for you, but make sure you do the thought experiments around what would be a good allocation strategy. And if this is your first time doing it and you're really uncomfortable, like by no means am I saying write something bigger, but we want you to have that mindset of what is an allocation strategy? And another thing to think about is if you're going to allocate over the next decade, and let's just pretend you put some, I don't know, you're still making income, let's say, and maybe you say that the portfolio is going to grow 5 or 10% a year. Maybe I have 1 million in the bank now, but maybe I know I'm going to have 2 million in the bank in 10 years. Right? So I could even be thinking about, all right, I'm investing and allocating checks over the next 10 years, and I might be thinking about where am I going to be in 10 years? Don't be crazy, right? I'm not saying expect a 20% return on your portfolio, but you can be strategic and smart with how you think about the allocation. The second bullet on the slide, love it. And I actually changed for the sub bullets. We always hear this, especially from women, especially from folks that didn't come from a family or community where investing was something that was accepted or talked about or promoted, which is, how do you get to confidence? And the truth is, you never get to 100% confidence, right? Over years of investing and maybe seeing liquidity events and feeling like you have more expertise, sure, you can build confidence, but it can take years. And 100% confidence isn't like the thing you need. It's really about just being insightful and strategic and smart. What are you doing? What are you getting out of this? How do you think about risk reward? How do you think about building a strategic portfolio for yourself that serves you, right? And the sub bullet, the second sub bullet, which is do the thing, it's a really fun phrase that I love that Dr. Edog, who's on, she's said it back to me as something that I've said, which is, changing your mindset by doing it. Because if you're just sitting on the sidelines and you're like, yeah, I'm just going to keep learning passively, it's not really going to transfer your mindset, right? But when you say, all right, I've done the work, I've done the legwork, and this is the check I want to write. By stepping in and allocating based on that strategy or based on that, thing that you've come up with, that really will change your mindset in the process. So that's why it says do the thing. And so, next up, let's talk about money a bit. And if you just squirmed in your seat, that's okay. It's probably expected. Feel free if you want to say show of hands, but I don't need to put you on the spot. Feel free if you want to share. How does it feel to talk about money? Are you kind of squirming a little bit? Do you talk about money with any of your friends? Yeah? Squirming, talk about it with friends. I'm seeing both, okay? And it's all fine. I'll tell you something, which is everyone has some form of money trauma. What does that mean? Maybe you inherited money. Maybe you are bad at managing or don't understand money. And so you get in some, debt cycle. Everybody has trauma, even people with money. How does it make you feel? Does it make you feel icky? If you haven't done that work around how do I use this in a way that serves me? How do I be conscious with, capital, all these things, and it's real work, you probably feel icky. By the way, investing as an angel and writing the checks into things you care about, that's some really great work right there. And you're not going to feel so icky about money when you really step into that. But basically, talking about money, speaking about investments. Rachel goes to we joke happy hours, and she talks about now shoulder dystocia because she's so excited about the latest check. That is engaging conversation, and now you might have a doctor, an obstetrician or somebody that says, wait, you know what? There's this startup, Rachel, or, can you tell me about that? And by talking about money and investing, we start to become more experts and we develop more confidence and we learn and we skill build. But if you don't talk about money, you're not going as deep on the skill building. And so just be aware, right? To master something, to have whether it's more confidence, better skills, don't be afraid to talk about it. And I'm not saying, show up at a birthday or a tea party and like only talk about money. That's not what I'm saying. But like, don't shy away from it if you're like, oh, I'll give you an example. I was networking yesterday with somebody who's a very high-powered, very connected, really interesting investor. And we're talking about some different things. And it was really interesting because when he shared, a bit about the work he does with venture, basically M&A or venture funding, he's like, I take on, a dozen clients a year. And because of my questions, he even shared what he charges, and like this, I wasn't like, hey, what do you charge hourly? But it was like, because of how I showed up in the conversation, I got more information and I even got more details around the types of thing he does. And it was really interesting. But if you don't ask the questions, you're not going to have that granular level of conversation, those additional data points. Um, you should definitely be talking about money with, folks like whether it's a partner you make decisions with, your wealth advisor or wealth manager. And an example I love to share is, oh, I love to share it for learning. I don't love to share it because of what it says, and you'll hear me in a second. I had a wealth team, nothing wrong with men, but there were no women on the team, and they came highly recommended. It was, by the way, I think very early in my She's Independent journey, or even before She's Independent. But anyway, uh, they just didn't hear me. I mean it. Like I would say something, and they just didn't hear me. And I don't know if it's they didn't hear me as a woman, they didn't hear me as a woman who, allocates private capital. But when they'd say things back to me, they didn't hear me. I'll give you an example. We talked about private allocations, which of course, wealth managers, I get it. Like that's not their area of expertise and they're not incentivized for you to invest privately. Be aware of that. But when I talked to them about it, I said, yeah, I sometimes write checks, 10, 15,000, sometimes more. And they said, it's so much work. You should be writing checks that are 50,000. And I said, well, I want to write more checks and I'm really excited about the businesses I'm investing in. They didn't hear me. There were other things they didn't hear me on, right? They're like, well, you should be allocating and spending more on your primary home to do this big renovation. And I said, oh, those were interesting personal decisions you made because of your big family. I don't have kids. I have my dog. I'm actually good with my, home and I like it. And maybe I'll do some smaller renovations, but this bigger quote, it just doesn't make sense. They weren't hearing me. Know your values and know where you want to, allocate that money and that wealth. They also made some poor decisions. And I ultimately am not working with them. But I'll give you another example, which was when I said, hey, I don't want you to allocate to BlackRock. They don't care about ESG. This is before the current administration in the States, where unfortunately, DEI and all these things are kind of out the window currently. But it's like again, maybe they're just thinking in dollars, but I also care where the money and the energy is flowing. So anyway, why do women often write smaller checks? I think this is a really significant one. And again, something to unpack. Thanks, Christina. Why do women write, smaller checks? We know this from data-driven research. Young women, young girls have been raised generationally to think of money with a scarcity mindset. It's save to buy the groceries, to keep the household. Women do have a significant majority and basically 90+% of, driving consumer spend globally, which is insane. So we should vote with our dollars, but recognizing that we weren't necessarily raised to take risk, where the men or the boys were raised to be like, all right, I'm going to buy that house. I'm going to, go bet. I'm going to ask the girl out and get no, and I'm going to ask the other one out. Like, it was a gender thing that happened generationally to us. And so stepping in and understanding that and unpacking that to recognize if you weren't the provider or, weren't taught these things, that's okay. And you can learn. So just an acknowledgement, you are not alone, believe me, on this stuff. And a lot of people, right, we're going through transitions. Maybe you decide in your 30s or 40s or 50s or 60s, I want to know what's going on with money. You can learn this stuff, right? So why did I say earlier, you don't want to make one investment or two investments? Basically, there's this concept in investing, diversification within your portfolio, which means it's really significant and really important, especially in angel, where it's high risk. You don't want just a few. You don't want just several. You don't want just a handful. The numbers that angels talk about, 15 or 20 plus. Don't be scared. You don't have to allocate it all this year. And think about, it's not just an angel check, right? You might have employee equity from working at a company, right? Like that's in your portfolio, and maybe private if it was a private company. But think about this stuff. What is diversification? We have some really great healthcare, experts in the group, and they love the healthcare deals we're doing. But half of our deals have been healthcare, and they're like, "Hey, we'd love to diversify into some other industries." That's a way to diversify. It doesn't just have to be one category. Public, private, your portfolio should be lots of things. It can be bonds, it can be small cap, it can be international exposure. And some of that, of course, is what you can work on externally from She's Independent. Maybe you have a wealth advisor, financial manager, or again, you want to be a part of that, which is awesome. But when you think about even your private allocations, right? Maybe you want to be focused on a few industries, there's nothing wrong with that. But again, just recognize you don't want just a few private investments of 10% of your net worth because, again, high risk. It doesn't just work out because you made a smart allocation decision based on risk reward. There's also luck. There's timing, right? There's other things. There's other factors at play. So just think about that. And the employee equity thing, and I'll also talk about like a home, for example. A lot of people make decisions where they're like, oh, well, I know the company well, or I'm using the home. So just be aware, right? Like you're probably outsized in some areas. Be aware of what that means. And in terms of expectations, how long are you holding the positions? I'm here kind of talking about this as though you're investing angel with us at She's Independent, but you could also invest in private companies externally. Or we may invest in companies that aren't as early stage as this slide is depicting. But in general, when you think about private, think about horse racing, right? You could be good at it. I know you're like, this is gambling, but you can be better at it. It doesn't just have to be like throwing darts. If you know the horses and the riders and who's good in what conditions, you can be better at it. You can have an edge. And so again, with Angel, it's you can have an edge and you can be smart with how you put the portfolio together, but it still is gambling, right? It still is risk. All investing is risk. And with Angel, especially if you're doing early stage or really early stage, there is very real chance that some of those companies are going to go to zero or be full write-offs. There's also a good chance if you're making smart allocations, that you're going to have some really good winners. And the big winners, we talk about it, to carry the portfolio of, I don't want to call them losers, but let's say just carry the portfolio to be nice. And so if your winners aren't making, 5 or 20 or maybe 50 times, and you have a high risk portfolio, it's probably not going to go so well. But if you're doing private investing and you're investing later, meaning maybe Series C, Series D, those are less risky than the earlier, seed Series A. So let me say that again. And I'll put it in other words. I've heard from not wealth managers. I've heard from, professional VCs, and they're like, I've invested in all these unicorns. And it's like, great, when did you invest? And they're like, yeah, they were, if you ask the questions, the valuation was 900 million before they invested. Am I impressed that they invested and then it went to $1 billion? I've invested in, a unicorn where the initial valuations, around 10 million. So just recognizing anyone can tell you whatever kind of story they want. Until you dig in, you don't really know what's going on. But again, risk, reward, stage, all things to think about. And dilution, which we're going to talk about it on a slide shortly, is also something you should expect. And we'll talk about how you can, plan for that. So dilution, what is it? I have a picture of a pie up here. You're like, why are we talking about money and why is there a pie? Think about it like this. And this is the analogy a lot of people use when they talk about it, or the metaphor, which is basically if you have a pie that's only so big and you give a piece away, what does that mean? Okay, you gave away a piece of that pie. But what if the pie grows in size? Meaning, when you're fundraising or when you have these valuations, ideally, and what usually happens is you're raising at higher and higher valuations. And so the idea is the pie is getting bigger. So even though you have less ownership, the percentage is smaller, your piece is getting bigger. So that's the whole pie analogy, right? And typically, it's 12% dilution, meaning your position is worth 12% less every year. That's on average when you look at these startups and fundraises. And that's roughly half from the employee equity pool, new employees or, expanding the pool, and then roughly half from fundraising. And then I have a term on here called pro rata, which is basically if you invest, you may have terms that say you have the ability or you're going to get the look, so you can invest in additional rounds to keep kind of that size of pie you have, right? And by no means do you have to do the re-up of investing, and we'll talk about that in a little bit, but just to be aware of what that means. So let's move on. And again, if anyone has questions, please, this is an open conversation. Tracy, I didn't know if you were going for the screen. I saw you reaching for something. So let's give some examples of this, because saying the thing and then seeing the example, can help tie it out. So first example of dilution. If you invest $10,000 at a $10 million post-money cap, let me just quickly define that. 10 million post-money cap means the valuation is 10 million with whatever funds were raised. So let's just say they were raising 9 million. Sorry, they were raising 1 million at a 9 million pre. That would be a 10 million post because 9 plus 1 is 10. So in this example of $10,000 you're investing at that 10 million post money cap, and if there are 5 years until an exit, again with that 12% dilution a year, that's roughly having your exposure. So if there's a $300 million exit, and here we're going to assume $4,000 in syndication fees and an 18% carry, this is your return, $126,000, and that's 11.6 times return. And we just want to contrast that with if in the next case there's no dilution, same example, no dilution. So you're going from what did we just say? Just again, I want you to see this, which it makes sense. 11.6 times return to a 22.8 times return. Now, is it realistic that a company that raises at 10 million has no dilution? No. And I'll be honest, but I'm giving you examples and scenarios. By the way, the example could have been they, exit at 600 million and, dilution versus no dilution. We're just coming up with numbers to give you some examples. Let's give you another example. In this case, it's basically the scenario where it's the $750 million exit. So I kind of just teed it up a little bit. But in this case, again, 5 years until exit with the lower, syndication fees and carry, and that's a 30 times return. And in this case, with no dilution, 58 times return. So you can, kind of look at the scenario. Why am I, giving you these examples? This is just to showcase completely, theoretical. These are examples of recognizing what the scenario may look like with or without dilution. And we're going to talk more about, the fees and how that plays in some other examples. But first, let's talk about, well, what is liquidity, right? Like what ultimately happens where I can get my check back or make money on it. And getting money back doesn't mean you're going to make a big return, but hopefully you'll get a return. So there's a few different ways in which you can have a liquidity event or the ability to get, money out of the investment. One of those is basically before a company exit, and there's what's called a secondary market, or the chance for liquidity because maybe an existing investor or a new investor wants to buy your position. or let's say our position if we, come in together, she's independent as one check. And then, at the company exit, of course, there's also, opportunity. So just being aware, and I'm going to actually explain, what some of these may look like. Um, But M&A, mergers and acquisitions, is a term, a blanket term you'll oftentimes hear around, what's going to happen, or corporate restructuring, right? There's different terms to say there's an event where maybe this company is buying another, maybe it's getting bought, maybe there's a restructuring or recap, maybe they're out of money, they're getting, something's happening, maybe they're going public, an IPO. There's a bunch of different scenarios. Notice on the bottom of the slide, it says dot, 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 or say goodbye to your money, right? Because it also could be we ran out of funds, right? There's all different types of exits, or I shouldn't call that an exit, but I would say kind of a goodbye exit. There's all different things, all different scenarios that can happen to a company. And remind yourself, right, when you're venture investing, it's not a cash flow business that's, kind of steady state and trying to keep the lights on and make payroll. Yes, venture may be trying to do those things, but venture is typically pouring gasoline on the fire and taking in a lot of capital to grow fast, to grow quickly, to go for a big exit. So you see a little bit of a blend depending on, who you invest in. But um, when you think of like a cash flow business, right? Like the corner store or the restaurant, um, you're not usually thinking so much of like these scenarios sometimes, right? You'll see a chain go public and maybe it's a food chain you really like. But, when we're thinking of tech companies or growth companies or scaling companies, these are the types of events that you see a lot more than those kind of traditional cash flow businesses that are really just kind of chugging along and probably have, bottom line profitability. Whereas a lot of these growth businesses are growing at a higher risk and, maybe burning capital to try to get really big. And M&A, of course, is one of the more significant things that a company can do, to add in terms of employees or, top line revenue or maybe EBITDA bottom line. And so, one of the things we just kind of brushed on earlier or just put up there on the slide is, what's your strategy? And again, it can take years to really develop your investor thesis and, to feel conviction around how you're investing. But just some things that, we want to put out there for you to think about. Do you want to reinvest? Angels, unless you have a ton of money, a lot of angels won't reinvest. And that's absolutely fine. Think about different factors. How much capital do I have? What are the terms if I put more money in? Meaning, if I got in at a 10 million valuation and they're saying that I can write another check, for reducing or, eliminating my dilution, but now they're raising it 100 million. Do I want to invest at 100 million? These are questions for you because your smaller check isn't going to go as far. And also they might not even really want to accept it if, they're raising it that high of a valuation. But basically just recognizing this kind of stuff. But on the reinvestment side, if you're, in with a team and a company and you absolutely love them and they're just taking off, maybe it is smart to reinvest. So again, just being aware of these concepts. And you don't need a black or white. It can be in the gray area. I usually don't, but sometimes I do. It's based on the context, right? Totally great. Fine, but just be aware. And then just to mention, uh, professional capital. And I say that not that we're not very good at what we do, but people that are literally paid professionally to do this, right? And they're taking money and, they have a bunch of, millions of dollars under management. They oftentimes have reserve funds to give more money to the companies to help them. So just be aware of that, right? Um, think about the valuation again, you may not want to invest at that higher valuation. Um, other ways to add value. So it's okay if you're not interested in this, but maybe you are, which is again, think advisory or board or fractional executives, introductions, jumping on calls. Are they offering you anything? Maybe not, but you still have it in your best interest to help this business. But maybe you only want to give them a free hour or two. Maybe otherwise, it's some other type of relationship, and that's okay. But know what you're up for, right? And know what your time and your value and all that's worth. Don't just give it away. But some angels will spend significant time. It's up to you. But just keep in mind, you don't want to just give everything away and spend, many hours trying to help a company that, by the way, maybe can't be helped. And back on that last slide, I want to quickly acknowledge the way a lot of angels think about it is they might choose to help companies that are in the doing okay, but we want to make them great. But if the company is already in the kind of garbage zone, it's maybe more of the write-off. If a company's doing awesome, they probably don't need you. But if a company is doing pretty well and they're like, hey, Trista, can you make this intro? And you know that they're like on the cusp, make the intro, right? But if Tracy knows that one of the investments she made is there, she just, doesn't love how they've been executing, and they're like, hey, Tracy, can you take a couple of calls with us? Maybe you can't, or maybe it's, you have to charge them something for it. So just think about where your time and your energy is going and your money's going. Quick recap on our portfolio. I already mentioned it, but healthcare, we have a lot of those deals. Clean tech and sustainability continue to be really interesting for us. Gosh, when the LA fires were blazing, we're like, why don't we have more in environmental? On average, the checks are running 70 or 75,000 right now, but it's a range. We've only done one follow-on, meaning one additional check in terms of the 15 different companies that we've had syndications in. So I guess it was kind of like the 16th check because it was into a company we already had exposure in. And it's been 3 years and we don't have exits, but we've already seen numerous companies in our portfolio that have raised at higher valuations. And one of those actually did allow for an opportunity at one point to come out with a 2x return. I shouldn't say 2x return. 2x meaning it would have been like basically one-time return, meaning 2 times what we put in. But just, being aware of what is that portfolio and, thinking about how are you tracking yours? How are you thinking about it? Getting excited about it, but also being sane. And in terms of, the individual check, because the 70 or 75,000, that's when we come together. So what does the individual look like when they are writing a check? So maybe Tracy's thinking about writing her first check. The median check size that we're seeing is $7,000. We actually do $2,500 increments. And so I'm kind of fibbing there. It's like $7,500. But it's closer to 7,500 than 5,000. The first check that we'll accept will be a $2,500 check minimum. And some people are writing checks that are 10 or 25,000. We had a $75,000 check on, one of our earlier syndications. And just being aware, again, it's based on that individual's maybe their thesis, their portfolio they're building. And if you were writing individual checks that were direct into a business, and we'll touch on that a little bit, those are typically 25 or 100,000 minimum. So just to recap on the individual check size. But what does it mean when we come together and we invest as a group? It's called a syndication. There are other groups where they're calling them special purpose vehicles or an SPV, and there are reasons for that. But basically, a syndication, which is what we do, it is when we form legally an entity that's called, or it is an LLC, and it's how we're able to invest as one line on the cap table so that the company doesn't have to manage all the different, small checks. That's what we're doing at She's Independent. We're managing the taxes. We will manage future distribution events. And we're doing it in a very cost-efficient way. And I want to repeat that. We are doing it in a very cost-efficient way. And you should be aware of costs, and we'll talk about that. If we don't invest as a group, as an entity, and you really liked a company that you saw, you can explore investment directly. And so it likely will be a higher check minimum. And, please be aware, if we didn't bring the company into diligence, we're not going to perform diligence on that business. You, of course, should. But just being aware, if you write a direct check, you're going to get the K1s, the tax forms, all of that for the business. And we'll actually define the K1 in just a second. But let's talk about fees. So at She's Independent, we have membership dues. These are annual dues because we do so much around curation and deal making and education. And when you syndicate or when we're putting a deal together, we are taking an amount out of that deal for syndication fees. And everyone does this when they create investment entities, vehicles. Ours, which we've been charging $4,000, Transparently, we're actually going to move it to 5 because now we've done all the legwork and we realize we were undercharging and we need to be sustainable. But compare that to every other group, it's $8,000 or $10,000 all in. The groups that are, or there's third parties that quote, oh, we'll do an SPV for $5,000. They're quoting the formation year. They're not even quoting the follow-up years for taxes. So we are making it extremely efficient and doing a lot of legwork to bring it down to this $4,000 or $5,000. 18% carried interest. Carried interest is this term. We also call it carry, which is basically when we invest, let's say we write a $100,000 check, 18% goes to, call it the house, but we really share it with members and folks in our group that helped source and screen and run diligence and all those things. The typical carry is 20 or 25%. So again, we're really transparent on this stuff, and we're really leading with this is an investor-friendly group. And there are no management fees, no management dues. We're going to talk about this, but we want to give you a transparent look in the outside world, which is typically, again, it's an $8,000 to $10,000 or more syndication cost. So again, ours is moving to $5,000, but still significantly less. If you invest as a what's called an LP or limited partner in a fund, they're going to be charging you typically 2% of the assets under management every year. So let's just say the fund is 5 years, 10 years. Every year they're taking 2%, and it's going to be 20+% for the carried interest. And you should be aware, and you should always read the fine print, especially in the, non-professionally managed groups, like some are charging 25% carry when they have no reason, like they shouldn't be doing it. And then sometimes they're charging higher on outperformers, which again, if you're an angel investor and somebody is taking 30% on your high performers, that is a big problem. Because again, the big performers, the outperformers, are carrying the rest of the portfolio. So all things we want you to transparently be aware of and think about and, apply to your logic and reasoning when you're investing. And so let's give a few more examples. So in this case, this is the 10,000, 10 money, 10 million post money cap. And by the way, why am I using terms like post money cap? So as an angel, we oftentimes are investing in safe rounds. And so that's a term we'll typically see, which is at conversion. That's what's the term, or you can also think about it as that is the valuation. But basically, I just want to get you a little bit more familiar with that type of terminology. But anyway, in this case, 80% carry, $4,000 syndication fees, no dilution, $100 million exit. So in this case, that's a 7x. If instead you have a 20% carry and $8,000 syndication fees, that's a 6.5% X. And now add on the management fees, right? So just to show you, it's not like you're completely breaking the bank, but it is ultimately impacting how much money you're going to get. And the opportunity for carry with us, is really interesting because as an angel group, we're so excited about this opportunity where anyone can step into leadership, right? And by stepping into leadership, and whether it's sourcing or screening, or maybe you don't have a finance background, but all of a sudden you're co-leading or leading diligence, amazing. You can get upside, for helping us with that. And so we're really excited about being able to share these types of opportunities, not just the leadership, but how do we source and screen all these great deals, that Rachel and Idong are kind of leading the charge on. It's because we're partnering with you all, and then we're sharing something for it. So we're really excited to be able to operate in this way, and of course, share some of that upside because of it. And just, a few examples, and these are dated ones, but I had them in here and just wanted to include what we had. But this is a deal that we didn't end up investing in, but Wander Health we looked at, and we had, outlined different pieces of carry based on the scenario of who sourced and, who was going to lead it. And then, we'd use a venture legal resource, Aravinda, who we love working with. So in that case, 15% of carry would have gone to members. 15% of the, I should say, of the 18%. Let's go back to that term K1. So if you have private equity or, private investments. You might already be familiar with it, but let's define it because this is new for a lot of people when they step into angel investing. A K1 is basically what we will prepare for you with our accounting team that you will have and receive and work with your accounting team to, prepare your taxes. And it's reporting cash flows and ownership for partnership agreements. And you'll get one the year you invested. And so if I make a 2025 investment, I'll get it for my, in 2026 for 2025 tax prep. And we're not going to require that you, file tax extensions. We'll get it to you in a reasonable time. Right now, we're actually preparing them for our 2024 investments. So folks are going to get those pretty soon. So the year you invest, you're going to get, that's a taxable event. And then if there's a substantial change to the investment entity, let's just say we did a follow-on, for example, and there's an ownership change, or if there's a liquidity event or a partial liquidity event, those would all be years in which we would then file and you would get additional K1s. I made some updates in terms of the pictures I had, and for some reason, some of them aren't working out. So we'll just go with it. But um, as the expectation of, what do you get as an investor? We get these investor updates. And investor updates are basically typically, plain text email. Sometimes it's a little bit more fun with a little bit more marketing in there. But basically, it's things like the company is telling us, and this is how we're doing. This is traction. These are asks, right? Hey, this is our runway. We're doing another raise. We'd love intros. We'd love, to be connected with, partners or new customers. Maybe share this on your LinkedIn. But these updates, and this, by the way, was a company we didn't invest in, but we looked at and we liked. But these updates often are going to be, pretty confidential. And so we do share them with our internal group and folks that invested. But again, these aren't things where you'd like go out on LinkedIn and be like, oh my gosh, the company just shared that they sold, blah, 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 blah. I might anecdotally share in certain closed rooms. Hey, and I know the company might share it in their newsletter. Hey, we invested in, Bone Health Technologies. And guess what? They already have $700,000 of pre-sale orders. Awesome. And if we know that they're sharing that publicly, maybe we'll share that. But typically it's these confidential, this is what's happening, because these are private companies. They don't have to report publicly, right? They're not listed on some public exchange. So you can engage and, wait for those updates, and you can ask us, oh my gosh, somebody didn't update yet. And back to updates. Was there any requirement? No. Some companies we invest in might update us monthly, some may update us quarterly, some may not even update us quarterly. But listen, depending on stage of business and depending on maybe these are first-time founders and they have a lot of stuff on their plate, I'm okay with it as long as they are responsive on some level. And when we do hear from them, it sounds like good work that they're doing. That's kind of my take on it. I think the other thing I would mention quickly is just proactive, communications when SVB was imploding and, everyone was all nervous. I really appreciated the companies that reached out proactively and said, hey, this is what's going on. Either we do or we don't have association with SVB. This is what we're doing on the cash side. Being proactive, it says a lot. And so just being thoughtful, right? So that's another aside, which is these companies can choose how they want to interact and communicate to us as founders, or sorry, as investors. Okay, so I know we covered a lot. Let's just kind of think about what's next for you all. We talked about some things from allocation strategy and expectations. Hopefully, you have some takeaways, whether it's a little bit of money trauma you need to unpack or thinking about the reverse engineering of, what's that next check you want to write. And when you think about this stuff, don't ever, talk down to yourself. I know we all have that ego or that thing in our head, the id that's like, hey, you can't do this. Like, just you rewrite the story as you want to. And the last point on the slide is like map a path, right? Have the goals, but really at the end of the day, it's about writing the check. I mean, that really is what we want to get you to. And writing a check you feel good about. We want you to, the more you invest, the more you participate and engage, the more you talk about things, you're going to develop, deeper skills and more confidence and expertise. And one day, after you write the check, or maybe after you start showing up at dinner parties and talking about, interesting health companies, you're going to be like, wow, I'm an investor, right? And it's really a fun journey. And so thank you for being, part of this with us. And I know it was a bit quiet today. We have regular office hours, as you know, but that's what we had prepared. So I'm going to stop the screen share. And if anyone would like to ask questions, share feedback, comments, of course, we are open book, as always. I love that Rachel is saying, invite her to parties. She won't always talk about birth complications and medical device innovations. Well, how many drinks in? But either way, love that. Edong, are you doing that yet? Are you talking about this stuff at parties?
That's a great question. I don't go to too many parties, but it's coming up in lots of other conversations.
Great. Love to hear it.
So,
Well, I'm talking about it in things like sauna because yeah, I don't go to too many parties these days either, but I have more recently been plugging in with the Boulder Chamber, which has been great, and been in some rooms with some very senior hospital and healthcare folks. And I'm name dropping them. And then I'm following up with a summary. So yeah.
Hi, I just had just a general question about deal
Yeah.
sourcing. Do you, you probably patched into this a little bit more than me, kind of given the current insane climate in the
Uh,
US. I'm wondering
yeah.
if is that helping in terms of like access to good, are people now foregoing these deals more than they
Yeah.
may have 3 years ago? And that's maybe a chance for us to,
Yeah.
you know, participate a bit
Trista,
more.
it's such a good question. And I want to remind everyone risk is always there. And we also, have our fear waves, let's say, of when markets are hyped up or, markets are quiet. I mean, that impacts our emotions and how we think. And frankly, when valuations are down and when markets are worse, those are typically better times to invest. Of course, structurally, something could be happening right now. We're actually organizing a member exclusive event to bring in multiple financial and investment professionals to talk about markets right now. But to your point, I do think some investors are pulling away or have said no to things that they've committed to because they're worried. But by no means is it like people aren't allocating, period. And again, I think it's recognition of we all have risk. We all have to play that journey of how do I feel and recognize, right? Again, when markets feel really good, they're probably overpriced. And so again, when markets are scary, oftentimes you will find good opportunities. I think when markets are, softer, we absolutely have seen, some more quality deal flow, and it's like, oh wow, can't believe this company hasn't raised yet. Like that's something that we've seen anecdotally, and that's many data points. But I don't know. I think that Rachel or Edong or if others want to weigh in, you're welcome to. But I would say the ongoing market softness because of just the market softness over the last couple of years in private is definitely something that we saw change, and it makes sense from 3 years ago. I'd say the last year was different than 3 years ago, of course. And we will have that member exclusive event. We're going to try to plan it on the sooner side, nearer term. Um, Absolutely.
yeah, I would say to adding to what Natalie just said, I think you know but not really last year, but the year before, we were seeing a lot of like bridge. I think they're called bridges, right? Natalie, like the bridge
Yeah.
to Series A, like where they're trying to raise a little on top of what they did before, and so that opened up some opportunities to invest in companies that typically the valuation or the check size have been much higher than what we could come in as. And I thought, that was a good thing for us because it gave us more opportunities. But I think towards the latter part of last year, you didn't really see so many of those coming through as much. So it seems like it's picking up a little bit. But I
Yeah, I
mean, in the
think
current environment, we'll see what happens.
it's a great example what Yidong is mentioning, which is yeah, we were seeing a bunch of bridges until the next priced round. And they're great companies, but it was, oh, we know this isn't the right funding environment to get another, couple million or 5 million. And so, they might have raised a few million, on preferential terms because of the market environment. And the other thing to think about is raising a safe as an example, which is a simple, way to raise and, less costly and, has advantages, doesn't make you mark down the price or the valuation because if the market, has come in, right? It's better to say, hey, here's good terms versus having a down round where it's a priced round lower than the last one. So we definitely saw for the last couple of years more of those kind of bridge rounds where Series A, before they close their or raise their Series B, or even to extend before they raise their Series A, it's like they would do another safe. Um, that was one of the trends we absolutely saw.
I'm definitely interested, Natalie, in the get together with investment professionals because
Yeah.
yeah, we are concerned about the
Yeah.
lack
Choices.
of leadership in our country right now.
Yeah. We try not to be too political, but you can tell I definitely lean into all the things anti-misogyny, anti-racism, you name it. And yeah, it's a scary time, and I think a lot of people are very clearly worried even to uh, too closely follow the news, and I get it, right, from a mental health perspective. That being said, I think that we all just need to remember that our dollars and allocations matter. And listen, even if at the end of the day, there's not going to be as much non-dilutive or grant funding. Um, if there is strategic money interested and what these medical device companies are doing is like substantial, I'm not overly concerned and it doesn't mean I won't invest. So I will say that way. But again, of course, it's tougher if, grants are going to be down. Um, so all things to think about. And in general, by the way, trust, which of course might have been presented as something that would somehow help us, definitely hurt the industry, right? Yeah. Great. So that was fun. I guess I will pause the recording.